This is Speak Up. I am Sandra Schulte. Welcome back to our show. Today, I am very happy to have Randall Smith with us. Randall is a veteran financial reporter who has written about investing on a freelance basis for the Wall Street Journal, the New York Times, and other publications. He retired in April 2012 after working at the Wall Street Journal for 30 years. There he covered the securities business, mergers, and money management. He worked for the Word on the Street column. Before that, he worked at the New York Post and the New York Daily News. He is the son of a New York City publicist. He was graduated from Harvard College. He served in the U.S. Navy as a lieutenant. He lives in Manhattan. He is the author of Prince of Silicon Valley, Frank Quattrone, and the dot-com bubble. In 2002, Smith and his colleague, Susan Pullian, won the George Polk Award for investigative and enterprise reporting that serves democracy. It was for stories about an investigation concerning brokers at Chris West's First Boston, which was then Mr. Quattrone's firm. Brokers, including some in Mr. Quattrone's group, charged clients expensive commissions in exchange for valuable shares of hot initial public offerings. In 2003, Smith and a group of his colleagues shared a Pulitzer Prize for articles about corporate scandals. Today, we will putting you on notice that private equity is coming for your 401k, your pension money. Take it away, Randall.
Thank you, Sandra. So the story says, with private equity funds on their way into workplace retirement plans, savers face a choice that matters. Are they worth adding to my portfolio? Private equity firms buy companies, often using borrowed money, with the goal of fixing them up and selling them later at a profit. The model has generated outsized gains for some investors in the years since the financial crisis, especially for institutions like pension funds and high net worth individuals. But because of their high fees and illiquidity, they traditionally have not been offered in 401k plans. Now, however, the Trump administration is working on rules that would let retirement plans offer private equity funds and other alternative investments to ordinary investors. Wall Street firms, which are eyeing trillions of dollars in potential new business, are lobbying hard for it. While it's likely to be a few years before such choices show up on many 401k menus, individual investors and financial advisors will be looking at the arguments for and against having at least part of a person's portfolio in private equity and whether the higher returns potentially will be worth the greater risk and higher fees.
Higher returns, but?
Industry boosters say everyday workers deserve access to private equity funds' returns potential. Through the first quarter of 2025, data provider State Street said private equity funds beat the S&P 500 by 2.5 percentage points annually for the past 20 years. Advocates also say that private equity offers diversification via access to returns from thousands of companies with more than $100 million in revenue before they go public, something that investors in only traditional assets can miss out on. By contrast, the public company population in the U.S. has dropped by half since the 1990s to around 4,000. Critics of private equity, though, offer several counter-arguments. For one thing, they say the stellar returns have faded in recent years. State Street's data show that 2.5 percentage point advantage over 20 years drops to only 0.4 points for the past 10 years and becomes a negative 2.5 points in the last 5 years. State Street said private equity returns have beaten weaker global stock index funds or stock indexes that some firms highlight by a wider margin of 4.6 points over the past 20 years, but this gap too is narrowed to just 0.4 points over the past 5 years. The trend is clear. In recent years, the excess return in the private market has been diminishing, says Nan Zhang, global head of State Street's Private Capital Index. The decade of 2010 to 2020 was a great period for private equity because lower post-crisis interest rates were a big driver of returns, says Mike Brandenmeier, who leads external private equity investing at Goldman Sachs Asset Management. As rates have risen since 2022, he adds, some fund managers have had to reprice asset values to reflect higher interest rates and narrow profit margins on investments. At the same time, both U.S. and global public stock markets have soared to record levels since 2022, worsening the comparisons for private equity.
Lack of transparency.
The returns argument is further undercut by the fact that returns are hard to measure because of a lack of reporting transparency. Unlike public funds whose returns are reported daily based on market moves, private equity funds generally report their returns only quarterly and by metrics that differ from mutual funds. Then they report mainly to their own investors. One metric is called internal rate of return, which reflects returns on investor money as they go in and out of the fund. There's also a public market equivalent, which is a shorthand score that compares a fund's returns to public market performance over the same period. Critics say the internal rate of return can be inflated by the use of subscription credit lines, which allow funds to borrow money against investors' committed capital in order to smooth out the capital call timing. The internal rates can also be inflated by taking profits on big winners early in a fund's life. Critics say the public market equivalent figure, which is not widely available, can also be inflated by reporting overly optimistic net asset values on unsold holdings. Investors should also be aware that firms can present funds' performance in the best possible light, as there is not any standard benchmark by which to compare private equity returns, critics say. Some point to a global stock index for comparison, while others use the S&P 500 index of the largest U.S. companies or the Russell 2000 index of small capitalization companies. At least a half a dozen databases track private equity returns, sometimes by using numbers provided by a fund's investors or else obtained under the Freedom of Information Act from the public pensions and other entities that invest in private equity. Even this data can be inflated when sponsors or investors don't include poorly performing funds.
They have the right to include data of whatever they wish, as there does not exist a standard method of recording like exists for companies in the public markets.
So there's the fee factor.
Yes, let's talk about the fee factor.
Another factor to consider when comparing, this is still my story, when comparing private equity returns versus those of stock and bond funds is the level of fees. Many traditional mutual funds and exchange-traded fund offerings and 401ks have fees well under 0.5%. In 2024, according to the Investment Company Institute, 401k plan participants who invested in stock mutual funds paid an average expense ratio of 0.26%. Private equity is much more costly, with management fees of 1.25% to 2% annually and a 20% share of profits. The fee disparity looms as BlackRock, the number one global money manager with $12.5 trillion in assets, looks to expand beyond its low-fee index fund franchise by taking 401ks into private assets. 1/3 of its revenues come from exchange-traded funds that pay only 0.17% in average annual fees.
Well, that's a big incentive.
Yeah. BlackRock, which has made 3 recent acquisitions in private markets, says it wants to boost its revenues from higher fee assets. In a 401k promotional report this year, BlackRock said adding private equity and private credit could boost lifetime returns in target date funds. The firm, which already offers active and passive target date funds, cited return assumptions of 11% for private equity, 8% for public stocks.
Private stocks, I think.
BlackRock plans a new 401k line with low-fee private asset allocations, which could include private equity. It aims to give the new line competitive fees and transparency. In a call with investors in July, BlackRock CEO Larry Fink suggested that the company's recent acquisition of Preqin, a provider of private data for private markets, could help it clear the future rules on putting private assets in 401ks.
Today, we're putting you on notice that private equity is coming for your 401k. The big question is, are there high-fee debt finance funds filled with investments in risky mid-sized companies worth adding to your portfolio? What is the purpose of 401k? What kinds of people rely on them, Randall?
Well, I think it might be helpful to step back and look at the history of retirement funds to understand how the 401k came into being and how it differs from a regular pension fund. In the era after World War II, most pension funds offered by big companies and state and local governments provided what's called a defined benefit, a set amount of money annually that would allow employees to retire after they reach age 60 or 65 or so and have some income to live on. This worked fine when the economy was booming in the 50s and 60s, but eventually this kind of hit the wall. The first big sign of this was in 1963 when the bankruptcy of Studebaker-Packard caused many of its former employees to lose all or part of their pensions because the company did not have the money to pay them. Because Studebaker was not the only company this happened to, simply one of the biggest. So about 10 years later, Congress stepped in, passed a law in 1974, which required companies to set aside enough money to cover pension promises and to contribute to a federal agency which guaranteed pensions for companies like Studebaker that failed but couldn't pay. Eventually, this defined benefit program proved onerous for a lot of companies, so who had to put money aside for these pensions and account for them in their assets. So in the next decade or so, a new form of retirement plan was developed which transferred the risk onto the employees rather than having the risk on the company, which might not have the money to pay. The new structure allowed companies to set aside money from their employees' paychecks for their employees to be invested during the employees' working careers. Money would be drawn down from this to fund their retirements. That format is now known as the 401k, which lets the money accumulate and tax-free like an IRA. It lets the companies off the hook because the employee does not depend on a company's promise of money being there for a pension. Instead of the defined benefit plan, these new plans are called defined contribution plans. The private equity business came of age in the 1980s when the defined benefit pension plans were still dominant and the 401k market was just getting started. Private equity offered the promise of greater returns on funds that stayed invested for 5 or 10 years. Private equity managers would take the money out in chunks from the pension fund investors and also from endowments and foundations. They would then invest the money in a few dozen companies over the life of the fund. The private equity funds also used borrowed money called leverage to finance company buyouts, which increased the returns when the companies did better. But it also increased the risk of losses if the companies they bought did not do well or fail. For example, Toys R Us and Henry Kravis private equity fund buying Revlon beauty products. For all this, the private equity businesses are able to charge fees which are much higher than that charged by regular stock and bond fund managers. This structure generally performed well in the 1990s and 2000s and into the decade beginning in 2010. But it has become a problem for private equity managers because the universe of old-style traditional defined benefit plans have stopped growing and has been shrinking on a relative basis as more companies switch to 401ks in order to avoid being on the hook. Therefore, the problem that has been emerging for private equity over the last 10 years is that the market they prospered in and sold to, defined benefit plans, foundations and college endowments, are stuffed with private equity investments, and some are having to sell. Rather than shrinking, the 401k market is growing a lot. So 401ks now are where the money is. Private equity recognizes this. 401ks are the growing market.
Where the money is.
Yeah, private equity wants in. But 401ks are currently required to provide daily pricing and liquidity for employees who are retiring. In contrast, private equity only prices their funds every 3 months or so. Private equity only provides liquidity when the companies they invest in are sold. When the companies are sold, when the money gets returned to the pension funds. Additionally, 401k plans generally charge low fees because they get sued if they do not. In contrast, private equity charges fees that are way higher. Now, the good news for private equity is that the Trump administration is backing a revision of the rules which would allow illiquid high-fee equity to be on the 401k menu or to be allowed for 401ks to invest in. Most likely, there may be some form or format that would allow more liquidity and transparency and about the quality of the investments on also lower fees.
To reiterate to our audience, what kinds of issues arise when you put private equity into 401ks? Let's enumerate them one by one. Let's start with high fees.
Well, at the moment, the management fees in 401k plans run anywhere between 0.1% for index funds and 0.5% or more for actively managed funds. So the current fee levels for many private equity plans are 2% per annum with a 20% share of profits. This is called 2 and 20. Over certain minimums, the share of the profits the investors pay is a lot higher.
Let's now talk about liquidity.
Most of the money in a private equity fund is locked up in investments that last several years for each of the companies being bought and sold. Normally, the investment is locked up till a company is sold. That's unlike publicly traded stocks and bonds, which generally get bought and sold at a market price every single day. So a much longer term investment horizon.
Yes, let's talk about that. Longer-term investment horizon.
So
what does that mean?
The duration of the investment is not determined by the day-to-day needs of the investor. One reason private equity has the possibility of outperforming public stocks, it's what's called the illiquidity premium. Because private equity funds have time to make serious changes to the companies they buy and aim to resell at much higher prices, the fund's managers give that process a higher valuation because of the possibilities of greater return.
Now let's talk about quality of the investment.
The companies which private equity buy and sell are usually much smaller than the largest publicly traded stock like Amazon, Apple, Meta, and Google. Because they're smaller and riskier, their credit quality may not be investment grade like most of the biggest public stocks.
Lack of daily pricing. How about that?
Well, we've mentioned this before. Public stocks and bonds, 401ks, allow their employees to go in and out of the funds on their menu at any time. This is needed for those employees retiring or changing employers or who need access to their funds for family emergencies and such.
How about potential legal liabilities?
Because the private equity funds generally charge higher fees, their presence on the menu may subject the employers to greater risk of litigation. New Trump rules are expected to shield the employers which put their plans into private equity deals, also known as funds, from charging higher fees. But all of this is to be decided.
Does private equity put their own money at risk in these investments?
Yes, they usually contribute a chunk of the funds or chunk of the firms or the manager's money, but the bulk still comes from outside investors.
What is the size of the 401k market vis-a-vis the pools that already invest in private equity?
The traditional defined benefit plan coming from both companies and the government has about 13 trillion in assets, but the 401k market has about 14 trillion. So another incentive for private equity to access the 401k market is that pool of funds is growing faster, and it also has very little private equity. Whereas the defined benefit plans, also endowments and foundations, are very much loaded up with private equity, and instead many of them are trying to reduce their private equity holdings. Private equity for the last decade has also been trying to market their concept and holdings to wealthy individuals who are a separate marketplace outside the 401k market.
Randall, can an investor take his money out of a private equity investment at any time or when he or she needs it? If not, why not?
At the moment, most of the funds that are in private vehicles are locked up.
I repeat, locked up for 8 or 10 years, I think?
Something like that. There are new public vehicles that offer liquidity every quarter, but only within the limits of, for example, 5% of the entire size of the fund.
How will this structure fit inside a 401k, which currently offers its participants daily pricing and liquidity?
That's the $64,000 question. The answers are still being worked out by the private equity business along with the current 401k providers. These 401k providers now mainly offer public stocks and bonds and money funds, which do have daily liquidity. This is especially valuable if an employee needs to fund an emergency. Public mutual funds already are allowed to have some of their assets in illiquid holdings, so it's not impossible for public mutual funds to figure out a structure. Big sales pitch from private equity is this can offer diversification. It's a wider opportunity set of companies to invest in. There's a possibility of greater returns from the debt with which the funds use borrowed money to juice the returns, and even from the illiquidity.
How are private equity funds doing these days? Why is there a glut of unsold companies inside their portfolios?
Private equity did pretty well in the period between '05 and 2005 to 2020, because that period covered the 2008 to '09 meltdown in the public stock markets. That meltdown did not hit private equity as hard. Private equity was also helped by the low interest rates which prevailed in the decade after the global financial crisis. As a result, investors chased these superior returns. But in the last 5 years, private equity has had a glut of unsold companies as interest rates rose in 2022. As a result, returns have trailed the public markets. Public markets have been booming thanks to the Biden economic stimulus programs and the growth of stocks like the Magnificent Seven and the AI market, which, after all, may be a bubble.
Yes, it might be a bubble. Randall, what kinds of questions should investors be asking?
Well, in this market, is it one size fits all in terms of when the money is returned?
Are the higher fees worth it?
As I mentioned, the industry and all the various money managers, both the ones in the 401k market now with regular stocks and bonds and the private equity managers as well, are trying to figure out what kind of structures would work for 401ks. They are doing this to some extent in consultation with regulators who are working on the new 401k rules for all of this. In the end, the companies that offer these 401k plans will have to decide whether it's worth adding private equity to the menus.
Is it worth hitching on to the new investment bandwagon?
Well,
it's a bandwagon.
they can ask the pension fund advisors what compensation the fund advisor gets or the company gets.
That's right, because they do get compensation for pushing this. What kind of environment does private equity need to do well?
Well, it's hard to say. One instance when private equity might outperform is when public markets fall due to an economic downturn because the investors panic. It can also appear to help private equity if interest rates are low or are falling. That cuts the private equity fund's cost of taking out debt, which they layer onto the firms they're helping become successful or whose failing businesses they are helping to turn around. In general, falling interest rates have helped private equity returns over much of the 4 decades between '81 and 2021.
When interest rates turn higher, what effect does this have on a small investor's investment?
Well, it's hard to tell because lots of other factors come into play, but it could be negative because it raises the cost of capital, or put differently, the cost of new debt or a loan. Thus, it cuts the asset's valuations.
Are the 2.5 points that State Street says exists, if true, worth it?
Well, again, that's the 20 years up through early 2025. It's a trade-off between the risk and return the companies that provide the 401k plans will have to judge for their employees. The possibility for higher returns and the magic word diversification are the biggest arguments that private equity and their advocates use to get private equity onto other people's menus.
Is there any return on investment guaranteed the invested by private equity?
Well, no, there's no guarantee. The return on publicly traded stocks isn't guaranteed either. Private equity advocates say there are more companies that are private than there are in the public market. So the justification argument that private equity dangles to add private equity to the menu is that because there are more companies out there beyond the public markets and thus more diversity, this exposure could boost returns.
Could be, maybe boost returns. Are different terms given the large investors like the big universities or pension funds or insurance companies as opposed to small investors?
Well, the big institutions generally get better deals. This is especially true if the individuals come in via feeder funds, which carry extra fees. But many 401k plans are big enough overall to qualify for lower institutional fees. So the planner has to decide what is the compelling argument or arguments, or is there to use private equity in the portfolio.
I'm wondering, do these larger investment companies get the first crack at the menu or what is available for the investors to invest in?
Well, I think one of the questions is the length of time that you have to stay. And, that can vary with the fund and how the companies in the fund are doing. There are some private equity funds that are putting their assets in continuation funds because they can't sell them all before the time the fund's planned life expires.
Again, let's talk about transparency. Is private equity transparent?
Well, the value of companies in each fund is generally reported only by the fund's accountants and only quarterly, unlike public markets, which the value of the companies is reported daily. So this can be a problem when there's a need for liquidity.
Some say that private equity is borrowing your money to make their investments, but are charging you an opportunity cost instead of you being paid interest or a fee on your money, sort of like in the way a bank will do.
Well, I wouldn't put it that way. The entire reason investors go into these funds is to try to do better than they can do in public markets. There are private credit funds which offer the opportunity to earn interest on such debt.
Why is a low-fee index fund like BlackRock entering into the private equity business?
BlackRock has said publicly one of their goals is to boost their own fees, which are fairly low for their index funds. But the fees would be higher when they'd be offering private equity and private credit assets.
To recap, what are some of the risks involved in investing in private equity?
Like we've talked about, high fees, illiquidity, lack of transparency, lack of daily pricing, risk or debt, risk of leverage, meaning debt, and offset by the possible diversification through a wider opportunity set of companies to invest in. Also, possibility of greater returns from the debt.
Remember, audience, that the greater diversity of companies includes companies of all types of qualities, that the lack of transparency to the quality of these companies in the portfolio and the percentage of those of different quality levels, percentage, in the portfolio constitutes the risk. Additionally, one does not know how leveraged the acquired companies are while they are taking on high levels of debt, which the companies might not be able to service after they are acquired by private equity. The upside, however, is the possibility that you might win the jackpot, the group of companies being acquired and turned around in the private equity fund or over-leveraged group you're investing in might contain a future deal, the needle in the haystack. It is your gamble. It is your trip to the casino. Or is it a smart, long-term investment, which might have no termination date? This is a teaser. Randall, I want to thank you so much for coming on this show and educating this audience. Until the next time, this is Speak Up. Have a wonderful, wonderful rest of the day. Goodbye.